Welcome to Mr. Rodman's Top 12 Highlights from Chapter 18. Today we're going to look at economic policy. Let's start by differentiating between fiscal and monetary policy. Fiscal policy being budgets, taxing and spending. Congress and the President, the executive branch and the legislative branch working together to control taxation and government spending in order to either stimulate or grow the economy or to slow the economy down, keep it from getting overheated, keep inflation from rising. Monetary policy is what the Fed uses to regulate the money supply. Think of it, as I talked about in class, of turning that faucet of money on or off, and also regulating how much or how little comes out of the faucet. So that's the money supply, and we'll use Bird in order to do that. We'll talk about that here in a second. But that's essentially the difference. Fiscal, budgetary, using taxing and spending, again, living on fiscal street, the S and the T, spending and taxing, and then monetary using Bird, the idea of bonds and interest rates and so forth, to help regulate the money supply that way. The four phases of the business cycle include what we talked about in terms of how the economy is either growing or shrinking. We obviously want to be in recovery or expansion, number four. We want to stay there. And we use fiscal and monetary policy in order to keep it there, or at least try and keep it there. And if we find that we're in recession or a contraction, then we try and bring it back to recovery or expansion so that the trough doesn't last very long and the government can bring it back to recovery and expansion. So we start with peak, what we see here as the peak, the top of the business cycle, the top of the roller coaster. Recession or contraction, this period where businesses lay off workers, they close stores. We don't want to be there. So the government will use fiscal policy to cut taxes and increase spending in order to help grow the economy, bring it back up and turn that trough around. Obviously, we don't want to stay down here. Nowhere to go but up, though. So by Congress and the President signing on to government spending and cutting taxes helps to bring about recovery. The Fed also using monetary policy to bring about recovery. And that's where we start to see businesses open, workers are being hired, additional workers are being hired, consumer confidence grows or is rising. And this is obviously where we want to be. The peak, obviously not where we want to be because we want to stay on that recovery and keep it as long as we can. And we usually don't know that we've reached the peak until we're on the decline, just like the roller coaster scenario that we talked about in class. And then obviously the recession, the contractionary period, leading us to a space that we don't want to be in. So the Fed will be using some type of monetary policy with regards to interest rates or bonds to help grow that economy and bring us back to recovery. How do we measure the health of the economy? Three ways. First, GDP, or the gross domestic product. Again, the definition here, the total dollar value of all final goods and services produced in a country within a given year. The idea here is that it's final goods and services, not intermediate goods. It's a final product that's being sold, so not the lumber to build your house, but the house itself. And within a country's borders, so from sea to shining sea, everything that is being produced in the 50 states would be included here as final goods and services. And within a given year, the idea from January 1 until December 31st, everything that is the total dollar value of those final goods and services would be included in GDP. If GDP continues to grow, then we obviously will see that the economy is growing, and we'll see that through GDP. If the GDP is not growing and we experience two quarters, of negative growth, we would see a recession, a recessionary period, and that would lead to that contraction. The depression would be the trough, an extremely bad recession. We obviously don't want to stay there. But the important piece here is how do we get the money, using monetary and fiscal policy, how do we get the economy back on track? And we use the fiscal policy of spending and taxing, and we use the monetary policy of the Fed to help control the money supply in order to increase confidence in the economy and get people working again. So this is the first way to measure the health of the economy. The second way is unemployment. And that is the number of people that are looking for work who can't find it. And the idea there is that if you have a recessionary period, chances are your unemployment is high or rising. Inflation, on the other hand, usually tends to be the inverse of unemployment, not always. But the idea is that inflation is that price level that's rising. We measure that, as we see here, with CPI, the Consumer Price Index, and looking at the basket goods of items that are put into the shopping cart each month. Measuring that price level from the rise in those prices will show us that inflation is on the rise, or inflation isn't really rising or going anywhere. And we can compare that from month to month, year to year, and over a longer period of time. As I said, it's not always inversely proportional to unemployment, and that's where we get this idea of stagflation, or what we saw in the 1970s, this idea where there is high inflation and high unemployment. Not a good scenario to have. Luckily, it doesn't happen often and is really hard to correct because it's a supply side issue, as opposed to trying to use monetary policy or fiscal policy to help encourage consumers to go out and increase demand for things that they can buy and help get the economy jump started again. So by using GDP, unemployment, and inflation, we can measure the health of the economy and get a pretty good read of what the health of the economy is overall. We talked about fiscal policy. Let's take a closer look in terms of how we grow the economy, looking at the center section here. We're going to increase government spending and cut taxes. By doing that, we increase government spending, businesses expand, we create more jobs. This is going to help grow the economy. Likewise, if we cut taxes, consumers are going to spend more money in the economy. This is also going to help grow the economy. Now, we're going to slow the economy down. Why would we do that? I always get that question. Why would we want to slow the economy down? Well, the answer is inflation. We don't want prices to rise to the point that people can't keep up and can't afford to buy the products that they need for their families. And their wages aren't going up at the same time, so you definitely don't want to have a situation where prices continue to rise and wages are stuck. And so we want to slow the economy down. And the fiscal policy, again, the executive and legislative branches, do this through cutting spending and raising taxes. By cutting spending, they're spending less on government programs. Businesses are going to spend less on hiring workers, opening new stores. This is going to keep the inflationary measures in check. Also, raising taxes is going to lead consumers to spend less money in the economy, which essentially is going to slow the economy down. So we would grow the economy if we were in a period where GDP was lagging, unemployment was rising, and or inflation was falling, or if unemployment was rising, in order to grow the economy, in order to keep things moving. Now remember, all inflation isn't bad. A little bit is okay, especially if you have low unemployment. It's not bad to have some inflation, but you don't want to have high inflation and high unemployment, as we talked about in the 70s. So let's transition now to monetary policy, looking at the Fed. There are 4 ways that the Fed can control monetary policy using the money supply. And again, that faucet of turning on or off the water of money that is possible for the Fed to control. When we talk money here in growing the economy, we're looking at things like bonds. The government can buy bonds, and they usually buy them to grow the economy. The idea here is they're buying them from people holding them, they're giving them cash, and then people are going to take that money from those securities or T-bills, treasury bills, bonds, whatever you want to call them, and they're using that money to go out and spend in the economy. So buying those bonds from bondholders will help to grow the economy. Now, conversely, in order to slow the economy down, they're going to sell bonds. They're going to sell bonds to people who are interested in buying them. They get a percentage rate on it if they keep it for the maturity time that the bond is ready to be sold, and they take the money and they hold on to it, and that essentially slows the economy down by selling those bonds. So I always tell students, we buy to grow and sell to slow, and that helps keep the economy either moving to grow the economy, putting more money back into the economy, or slowing the economy down by selling those bonds, taking that money out of the economy, and thus keeping consumers from spending it. Now, interest rates are essentially those rates that banks can charge to customers, and those would be lowered to grow the economy and raised to slow the economy down. Reserve requirements: how much should a bank have on hand in order to make sure that they have enough money to meet customers' demands if they come in and require that, hey, I want my money back. That's a reserve requirement, and usually it's a percentage of the total amount of deposits that they have at the bank. They lower this reserve requirement in order to grow the economy, and they raise it in order to slow the economy down. Again, just like interest rates, they're going to lower those rates to grow the economy. They're going to raise them to slow the economy down. And the last one is the discount rate, and that's essentially the amount that is being charged to banks in order to borrow money either from the Fed or other banks. We also call this the discount window. And the idea here is, in short, the idea is in order to grow the economy, the Fed's going to lower that discount rate. And again, to slow the economy down, they're going to raise that discount rate. You're going to be much more likely to borrow from the discount window at a lower rate and take the money that you have on in the daily basis in terms of deposits and loan it out to more people. That means more people have a chance to get a loan on a car or a home or a student loan, and they can go out and spend that money in the economy. And that helps grow the economy. By raising those rates that we see here, they're less likely to then loan that money out to people that are going to buy a car or a home or take out a loan for a home equity for a remodel or an addition they're putting on their house. They're less likely to do that when the Fed raises rates. So that keeps the economy in check in terms of less people going out and taking advantage of those loans because the banks aren't loaning as many of them. So that tends to help slow the economy down. So buy to grow and sell to slow for bonds, and lowering rates on interest rates, reserve requirements, and the discount rate in order to grow the economy, and raising those rates to slow the economy down. The idea of managing the fiscal policy is to grow the economy, but also to slow the economy, as I mentioned. So to grow the economy, we're going to increase government spending and cut taxes. To slow it down, raise taxes, cut government spending. And then for monetary policy, to grow the economy, we're going to buy bonds, we're going to lower rates, and to slow the economy down, we're going to sell bonds and raise rates. And that's essentially managing fiscal and monetary policy. Now let's talk about spending for a moment. We kind of touched on this in class in terms of the different types of spending. Mandatory spending are entitlements. That's entitlement spending. It's non-discretionary. It's stuff that you have to spend money on, Social Security and Medicare. Discretionary spending is where Congress and the president basically get to decide how to spend it. Now the president proposes the budget, but Congress essentially gets to pass the budget, and then the president gets to sign it. So discretionary spending, that 1.17 trillion that we looked at, is essentially where the Congress gets to spend their money. And that is the only part of the budget really that is discretionary, that they actually get to choose. The rest of it, all mandatory spending or interest on the debt, which tends to be mandatory as well. Nobody wants to default on the debt. Tax expenditures are essentially some type of benefit that's given to a group. Maybe it's a tax cut or a tax benefit to a group. That's a tax expenditure. The idea is you're losing tax revenue in order to give some type of benefit to a group. The mortgage interest deduction is a good example of this, because basically people get to take money off of their mortgage for the interest that they paid, and that is essentially not off their mortgage but off their taxes for the interest that they've paid on their mortgage. And this is a benefit to that group. It encourages people to go out and buy homes, but it is a loss of tax revenue that needs to be made up somewhere else unless you're going to cut spending to go with it. The $4.2 trillion spending budget, you can see here, Medicare and Social Security eating up 61% of the budget. We have interest on the debt over here at 7%, and essentially 1.1 trillion, 1.4 trillion in Social Security, 1.2 trillion in Medicare, a significant number that's in that non-discretionary or mandatory category that we talked about here, the mandatory spending. So a significant part of that budget. The discretionary spending basically coming from these various areas. In FY17, this was the breakdown: 54% on the military, 7% in veterans, and you can see that breakdown there, but usually under 10% in all of the other categories that we see here in terms of the overall budget and what's outlaid there. So very important in terms of those outlays of discretionary spending. And you can see the various departments in terms of what is spent. Education about 6%, about $72 billion. And in terms of President Trump's budget, we'll see how that lays out for FY18. Don't have the charts on that just yet, but the military spending, we know that it is very important. He wants to spend more in that particular area, so we would see an increase from even the 600 billion that we see here. All right, let's talk taxes for a moment. The progressive taxes are essentially the more you make, the more they take. A higher percentage for people that make more money. Regressive taxes, these are things like taxes on food that really hit lower income people the hardest because they're paying a higher percentage of what they make to pay for those taxes. So that's why we call it regressive, because it hits the people that have the least amount of money the hardest with those types of taxes. So you don't see those as being very popular in terms of the regressive taxation structure. Usually what we see is progressive in terms of the more you make, the more they take. There's also the flat or proportional tax. Herman Cain, back in the 2012 presidential election, he was a candidate for the Republican Party, and he came up with the 999 plan, basically a flat tax. Everybody pay 9% across the board, no matter what income tax bracket that you're in. That didn't go anywhere, neither did Herman Cain, but the idea there is it is a good example of the flat tax, which is always an option. Deficits versus the debt, always something that students get a little confused. Deficit is basically what we have each year that we bring in money to the federal government through taxes, and then what money we use to spend on programs. So what you have left over, if anything, would be a surplus. What you don't have left over, if you've paid out more than you've brought in tax revenue, would be the deficit. And that's for each fiscal year. That's October 1st through September 30th. The deficit is the idea that you're spending more than you're bringing in tax revenue, and that adds to the debt each year. So all of those deficits that you see here are adding to the overall national debt, which is over $19 trillion now. And that averages out to about $159,000 per taxpayer. If you'd like to make your check payable now, you may. No, bad joke, just kidding. But the idea here is that the deficits contribute to the debt, and that's always something that confuses students. So the deficits are what's tallied each year in terms of the government spending more than it has and more than it's bringing in tax revenue. And it adds to the national debt, which is that $19 trillion number. How does the budget process work? Well, quite simply, we've got OMB, and we kind of talked about this with the executive branch, but the OMB basically proposes a budget on behalf of the president approves it and then sends it to Congress. Congress approves the budget. Sometimes they don't even pay any attention to the president's budget if they don't desire, and it all depends on what the president is proposing and where they go from there. The CBO then is going to score it, basically saying, okay, this is how much the budget really is going to cost and where the money's going to go. And then the Congress would approve it, and the president would either sign it or veto it into law. Now, President Obama and Congress didn't always agree on this. And now President Trump and Congress, the President Trump has essentially proposed a budget, and many in Congress, including Republicans, say we're going to have to spend a little time working on that. And that is the job that they do. So that's why they have proposed it usually in February or March, and it will take them until even sometimes past September to approve a budget. Sometimes they'll approve a temporary measure to keep the government going past October 1st. But if they don't pass one, then that's where we have a government shutdown because the government can't pay its bills. But that essentially is the process in terms of how that works. And each agency would submit budgets as part of that plan in terms of the president and the OMB team creating their budget each year. So now that Congress has the budget, the president's team will go back and will start working with different departments on the next budget that will be proposed a year from now. And that's essentially how the process will repeat itself. Government spending, they have tried and tried, Congress and the president have tried and outlined all kinds of ways to cut and curbs government spending. Graham Rodman was probably one of the most famous, basically calling for automatic cuts. This idea is called sequestration. And basically saying that if there's lack of agreement in terms of President and Congress on what should be cut and how we should balance this budget, then we're going to have automatic across the board cuts, what we call the sequester. You can imagine the devastation that this could have on different types of necessary cuts, such as the military or other healthcare benefits for people that really need it. And so Congress always talks about how wonderful this bill was, but then they always find a bill that they pass that will go around it or try and undercut it in terms of the the overall spending to that budget. So while it's a great idea, most of the time since then, and we've seen this now for what, almost 30 years, um, that Congress will find a way to get around it in terms of their budget. And a lot of times they're spending more than they're bringing in, or they're budgeting for more than they're bringing in. And as a result, we end up with deficits which contribute again to the national debt. So let's talk about the types of economic policy here for a moment. Laissez-faire is this classical approach, this idea that government should get out of the picture and leave business alone, kind of let the economy correct itself. And do its own thing. Keynesian theory suggests that the idea here is that in bad times we should spend using deficits and really spend our way out of problems, because in the long run we may have to wait for the government or for the economy to correct itself in the classical approach, and we might all be dead by then before it actually does do a correction. And that's where you may have heard the expression, in the long run we're all dead. That's coming from Keynes and the idea that you can increase spending and cut taxes and run a deficit. And in the short run, it's not a bad thing because it helps get the government back on track, gets us back on that recovery or expansionary part of the business cycle. And then Reaganomics is the idea of monetarism, this idea of managing the money supply, using the Fed to help with that, but also cutting domestic spending, increasing military spending, cutting inflation where you can, allowing some interest rates to rise in order to help with unemployment, cutting different types of taxes in some areas and increasing them in others, but using some Keynesian policy in terms of that military spending and in helping the money supply, but really trying to stimulate the economy and improve it for businesses so that they can hire workers and cut unemployment. And that's essentially the idea of Reaganomics, named after President Ronald Reagan. But the real idea here is to use the fiscal and monetary policy to really control interest rates and to control taxing and spending. Only spending in those areas where it's absolutely needed, such as the military and so forth, cutting a lot of domestic programs where he didn't feel they were needed, and then controlling the money supply to try and encourage the businesses to hire workers and decrease unemployment. Protectionism versus free trade is something we're hearing a lot lately, especially with President Trump's executive order to get rid of TPP, the Trans-Pacific Partnership. Protectionism is this idea of protecting domestic jobs and the concerns around unfair competition. There are trade barriers that countries can put up in order to protect jobs, but as we know from the 1920s, this can be dangerous because other countries can also put up trade barriers to this, which is why we've been really trying to establish more of a free trade argument. Now, the Bernie Sanders camp and the Donald Trump camp, in terms of the candidates, this really didn't resonate with a lot of voters because it hurt American jobs, and the concern was you're giving free trade to other countries and you're taking those American jobs with it. And many people voted at the polls concerning that particular issue. So while economists are very supportive of free trade, we know that politicians aren't, because a lot of times they have to get reelected. So there is a fine line here in terms of trying to find a balance, and members of Congress have yet to find that balance, as it is shown from the 2016 election with President Trump and his supporters of ripping up the Trans-Pacific Partnership Agreement with China and other Asian nations. In terms of global trade organizations, the three you need to know, the one you're probably most familiar with is NAFTA. That's the North American Free Trade Agreement, which basically removed all of the barriers, or most of them, from the trade that was happening between the US, Mexico, and Canada. The World Trade Organization is one that enforces different agreements and essentially includes about 80% of the trade that happens between countries that are members of WTO. GATT is the General Agreement on Tariffs and Trade, and this is basically kind of like a treaty in which different countries have agreed that these are the standards in which we will abide by when it comes to taxes, when it comes to trade, and using the WTO to enforce those types of agreements is really where they get their teeth. That's really the problem, though, is that the WTO doesn't have a lot of teeth, and so they can enforce trade agreements all they want, but what impact and what can they really do. It's not like they can fine an organization or they can force them to pay. So a lot of it's very voluntary and thus not a lot of teeth, which is part of the problem. So that leads to the regulation versus deregulation as economic policy theory, which is this idea that do we regulate, do we deregulate, which one works? Many liberals tend to feel more regulation is necessary in order to keep business from overreach, and many conservatives feel deregulation is necessary in order to give businesses to free the strings of regulation so that they can hire more workers and boost employment and help in that regard. We have seen monopolies in particular industries. The trust busters happening during the time of Teddy Roosevelt are a good example in the late 19th century. The idea of breaking those up in the trust busting. We saw the antitrust legislation with the Sherman Antitrust Act trying to prevent different monopolies from taking over an industry and not allowing other people to participate in trade. So we have seen these throughout time, and there's a lot of controversy in terms of companies today and are they moving in this direction with mergers and acquisitions and more companies that are becoming larger and larger. The banks, for instance, is there more of an antitrust type of environment that's going on there? Are monopolies being created among the telecommunications companies or other types of large institutions? Another area that saw a lot of deregulation was the airline industry, and the result was we saw lower fares, but the service was horrible. So there were many that said, well, maybe we should do a little more regulation of this industry. Now we've also seen a lot of mergers here, and we have a few carriers, that kind of have bubbled up as being the majors. So to be continued in terms of what happens there. And we also saw a lot of banking deregulation in the 1980s around banking, around banks, and banks that could participate in some more investment functions in addition to deposits and loans. And this created part of the financial bubble, and there's a lot of controversy about whether or not allowing banks to go back into some of those industries after some of the Dodd-Frank legislation that we saw in Congress, whether that's a good idea or not. So to be continued on that particular area of controversy with this type of economic policy. That pretty much wraps up Chapter 18. I hope you found this helpful. On the top 12 highlights, economic policy. Remember fiscal and monetary policy, the idea of taxing and spending for fiscal policy, and monetary policy, BIRD, bonds, interest rates, reserve requirements, the discount rate. We buy to grow and sell to slow, raise rates to slow the economy down, lower rates to grow the economy and keep it moving. Live the 5. I hope you do well on the quiz, test, and the exam. Have a great day.